Hey there, future millionaires. Welcome to Investment Island, where the waves are green and the opportunities are endless. Today, we're diving into the exciting world of margin trading. Don't worry, it's not as complicated as it sounds. Think of margin as a turbocharger for your investments. It's a way to potentially boost your returns, but hold on. Before you hit the gas, we need to understand how this powerful tool works. Just like navigating a ship, investing requires knowledge and caution. We'll break down margin trading together so you can set sail with confidence. So what exactly is margin? In simple terms, it's like borrowing money from your broker to buy more investments than you could with just your cash. Imagine it as a loan that helps you amplify your buying power. This can be particularly useful if you spot a lucrative investment opportunity but don't have enough cash on hand. Let's say you have $5,000 to invest. With a margin account, you might be able to borrow another $5,000 from your broker. Now you have $10,000 to play with. This increased capital can significantly boost your potential returns. This means you can potentially buy twice as many shares or other assets. For example, if a stock you believe in is priced at $100 per share, you could buy 100 shares instead of just 50. But remember, this loan isn't free. There are costs associated with borrowing money. You'll usually pay interest on the borrowed amount. The interest rate can vary depending on your broker and the terms of your margin account. Plus, margin trading comes with its own set of risks, which we'll explore in a bit. It's important to understand that while margin can amplify your gains, it can also amplify your losses. If the value of your investments drops, you could end up owing more than you initially invested. Always make sure to read the fine print and fully understand the terms and conditions of your margin account. Consult with a financial advisor to ensure that margin trading aligns with your investment goals and risk tolerance. Diversification can also help mitigate some of the risks associated with margin trading. By spreading your investments across different assets, you can reduce the impact of a single investment's poor performance on your overall portfolio. When used wisely, margin can be a powerful tool in your investing arsenal, but always proceed with caution and make informed decisions. Let's say you're a young entrepreneur running a lemonade stand. You've set up your stand on a sunny day, and customers are lining up to buy your refreshing lemonade. You're doing well, but you see an opportunity to expand. You notice that the demand for your lemonade is increasing, and you start dreaming bigger. You need a bigger stand and more lemons to meet the growing demand. You realize that to keep up with the customers, you need to invest in more supplies and a larger setup. You go to your friend, the broker, and ask for a loan. You explain your vision and how the investment will help you grow your business. Your friend believes in your lemonade empire, so they lend you the money. They see the potential in your idea and trust that you will make it work. You use the loan to buy more supplies and build a bigger stand. Business booms. With the new setup, you attract even more customers, and your sales skyrocket. You sell tons of lemonade, repay the loan, and still have extra cash left over. Your hard work and smart investment pay off, and you see your profits grow. That's margin working for you. The extra money you made after repaying the loan is your profit, and it shows how effective your business strategy was. But what if your lemonade stand doesn't do so well? Sometimes, despite your best efforts, things don't go as planned. We'll get to that in a bit. Stay tuned to learn how to handle challenges and turn setbacks into opportunities. The biggest advantage of margin is the potential for amplified returns. Remember that lemonade stand? By borrowing money, you were able to buy more supplies and grow your business faster. The same principle applies to investing. With margin, even small price increases in your investments can translate to larger profits. It's like catching a bigger wave while surfing. You get to ride the momentum and potentially reach your financial goals faster. However, it's crucial to remember that margin magnifies both profits and losses. Just like a bigger wave can knock you down harder, losses can be amplified when you're using borrowed money. Now let's talk about the risks. Remember that loan you took from your friend for the lemonade stand? What if the weather turned sour and nobody wanted lemonade anymore? You'd still owe your friend the money even if your business wasn't making any profit. The same goes for margin trading. If your investments lose value, you still have to repay the loan to your broker, plus interest. In some cases, your losses could even exceed your initial investment. That's why it's crucial to use margin cautiously and understand the potential downsides. Never invest more than you can afford to lose, especially when using borrowed money. Section 6. Margin call, your wake-up call. Here's a term you need to know. Margin call. It's a critical concept in the world of investing, especially if you're using borrowed money to trade. Think of it as a warning siren going off, alerting you that your investments aren't performing as expected. It's a signal that immediate action is required. When you use margin, your broker will set a minimum amount of equity you need to maintain in your account. This is known as the maintenance margin. If your investments lose value and your equity falls below this minimum, you'll get a margin call. This is essentially your broker's way of saying you need to shore up your account. This means you'll need to deposit more money or sell some of your investments to bring your equity back up. It's a way to protect both you and your broker from further losses. Ignoring a margin call can lead to your broker selling your investments without your consent to cover the losses. This is known as a forced sale, and it can happen very quickly. This can be a stressful and costly situation, so it's best to avoid it altogether. Always keep an eye on your investments and maintain a buffer to prevent margin calls. Understanding margin calls and how to manage them is crucial for any investor. Stay informed, stay prepared, and you'll navigate the financial markets more confidently. Section 7. Knowledge is power. Understanding your risk tolerance. Before you even think about using margin, you need to understand your risk tolerance. Are you comfortable with the possibility of losing more money than you initially invested? If the thought of it keeps you up at night, margin trading might not be for you. Investing is a personal journey. There's no one-size-fits-all approach. It's essential to choose strategies that align with your financial goals, risk tolerance, and investment timeline. Remember, investing isn't about getting rich quick. It's about making informed decisions and growing your wealth over time. Section 8. Charting your course. Seeking professional advice. Navigating the world of margin trading can be tricky, especially for beginners. That's why it's always a good idea to seek advice from a qualified financial advisor. A financial advisor can help you understand the ins and outs of margin, assess your risk tolerance, and develop a personalized investment strategy that meets your specific needs. Think of a financial advisor as your co-captain on this investment voyage. They can provide valuable insights and guidance to help you navigate the ups and downs of the market. Section 9. Set sail with confidence. Margin trading can be a powerful tool for experienced investors, but it's not for the faint of heart. It's crucial to understand both the potential benefits and the risks involved before diving in. Remember, knowledge is your most valuable asset. Do your research, seek professional advice, and never invest more than you can afford to lose. Now that you have a better understanding of margin, you're one step closer to becoming a savvy investor. If you found this breakdown helpful, hit that like button and subscribe to my channel for more investing tips and tricks. Until next time, happy investing.